I am Hermina. I am an investment director at Big Society Capital. Big Society Capital is a social investment wholesaler, which means that it invests in other social investors. So we don't invest directly in frontline organizations. But before that, I was actually working for Social and Sustainable Capital, who did invest in frontline organizations. Social finance or social investment usually refers to repayable finance to charities and social enterprises. So that means that as opposed to grants or donations, which you don't have to pay back, social finance has to be paid back, and typically that involves an interest payment as well. It could be either loans or equity. And I will refer to the Good Finance website that explains what types of investments can qualify as social investments. In the broadest sense, it is either a loan or an equity instrument, but it could be different kinds of loans. It could be secured loans or unsecured loans. And by secured, it means that it's like a mortgage. You would just sort of use an asset as the collateral for the bank, but often that's not needed. And in terms of equity, there are some forms of shares that are specific to social investment, helpfully called community shares, for example. So in the broad sense, it is either debt or equity, but there is a variety of different types of investment in each category. As early as you can, as early as you're available. Typically, charities and social enterprises already have relationships with grant funders or foundations. And other social investors, you can think about them the same way, as in just broadening the network of relationships that can help you fund your organization. And how to go about it and where to meet the social investors. Again, the Good Finance website, but very helpfully, Good Finance with Big Society Capital organize these events that are called Let's Talk Good Finance. They're organized all across the UK, and they bring together local social enterprises with social investors from anywhere in the country, and yeah, just get introduced and to start a conversation. I think actually probably the opposite. I think many times social finance is used as a bridge. It's appropriate at the time when grants are drying up or not available, or the size of the grants is not available, and it's before an organization is large enough to be able to go to their local bank or commercial bank to get a loan on commercial terms. So a lot of the time, social finance can actually help an organization scale from a fairly small size to becoming larger. And there's such a range of social investments, loans or equity, that they can start from fairly small amounts and then grow along with the organization. Well, it depends what you want to do with that cash and what would you like to borrow money for. I think often organizations I've personally worked with prefer to preserve their cash, especially for unexpected emergencies like we've seen COVID-19, when organizations had to draw on their cash reserves to continue to deliver their services, to keep their staff employed, or pay the top up the furlough payments. So they don't really want to either spend those reserves or lock them up in, say, a deposit for a mortgage. And that's where a loan can be very appropriate, because it can help you buy an asset without having to spend your reserves. And alongside with it, it may help you also build a team. Equally, if it helps you hire a sales manager who generates sales, it could also be appropriate. But the principle is, when you take out a loan, it's helpful to have a revenue model that helps you pay the interest on the loan and have a plan on how you will repay the full loan in the long term. It's a different kind of risk. And what I hear from charities a lot is that there is a huge risk related to grants and donations funding, because there's a huge uncertainty around it. A lot of the times the grants are time bound. They're 1, 2, or maximum 3-year grants. There's a lot of organizational resource that goes into grant applications, and there's a risk that the grant won't be renewed after it expires. And similarly with donations, they can go up and down. It's very hard to predict. So from that perspective, a loan can be a lot less risky. It gives you a lot more predictability. And if we talk specifically about social finance, actually that's going to be less risky than just normal commercial finance, because social investors have a reputational investment as well in their in the frontline organizations. So really what happened during COVID is that social investors granted interest freezes, loan repayment holidays. They were very flexible in changing the terms of the loan, and also helped social organizations to access grants and other sources of funding. So social investors will be very careful to try to tide the organizations over. So I would say that actually, in many ways, taking a social investor on board de-risks the organizations, makes the project less risky. But again, the question is why? I mean, I could understand that there's a lot of time and effort that goes into grant applications. So, and there's uncertainty around how long the grant will be available and whether it will be renewed. And equally, many grants have quite restrictive terms in terms of what they can be used for. They can be used for, the most frequent complaint that I hear is that you can't cover core costs out of the grant, and it's very hard to deliver a project without having, the background organization to deliver the project. So that's why people might want to look at alternative to grants. Blended finance is, in a way, almost like the best of both worlds. We normally refer to blended finance when there's one funding package that has one component that is non-repayable, so grant, and one component that is repayable, a loan or sometimes an equity investment. Usually the grant is less than half of the total amount, so you'd say something like 25% grant and 75% the loan, where the loan carries an interest rate of 5% and has to be repaid over 5 years. Effectively, for the organization, that means that they can get a larger sum of money at a lower cost because they don't pay any interest on the grant. They don't have to repay the grant. And the other thing, if they were to borrow the entire amount, they'd have to repay it. And probably grants for the entire amount are not really available. I think a lot of grant funders like to work with social investors because they feel that makes the organization, that gives a reassurance that the organization will focus on sustainability and resilience and continuity of service, rather than if they just received the grant and they didn't have any further oversight after 3 years. But in a more general sense, I would say many organizations build their own informal blended finance packages because most of the organizations I worked with had some grants and some social investments, some loans, maybe some equity. And even though they were for different projects, they just have a whole package that they work with that includes all of these types of funding. Having a plan on how you will repay the investment and how you will meet interest payments is quite important when taking social investments. So if that kind of plan is not in place, so if the organization has been making losses and they just need to cover costs basically, but without generating other revenues to meet that gap, then social investment might not be the best solution. Although last year, we did have the business continuity loans that were put in place, although even those assumed that they're tiding the organization over for about 2 years, but then those had to be repaid as well.